Hello and welcome. Moss Adams is pleased that you've joined us for today's session, Inflation Reduction Act, Clean Vehicle Tax Incentives. Before we begin, I'm going to play our brief housekeeping video.
Welcome, and thank you for viewing our webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
Hi.
All right, and before we kick off this first polling question, I would like to introduce today's presenters from Moss Adams. We have Craig Lammlin, Director, and Gabe Sermeno, Senior Manager. Their bios and contact information are located in your webcast console for your convenience. And now I'll turn the floor over to Craig to get us going.
Thanks, I appreciate that. So just to get a feel for the audience, which of the following best describes your business? Are you in the logistics transportation industry? Are you a fleet operator? Are you an auto dealership? Maybe you're other. Maybe you are in the process of developing some mobile machinery. So if you wouldn't mind just inputting what you are, that would be great to give us some context for purposes of our presentation. We'll just give a moment. And as we're doing this, the reason we're doing this is because when we talk about the Inflation Reduction Act in greater detail, there will be certain aspects of these programs that may be more relevant for certain parts of our audience than other. And so with that, I think we're getting reasonably close. So we have a lot in other, that's great. A number of auto dealers, fleet operations and logistics and transportation. So this is a pretty good, I think, subset of the types of industries that these programs are really targeted at. So with that, we'll move on to the second polling question, which is, so now that we understand who our audience is, what are you most interested in learning about today? So you have clean commercial vehicle credits, you have new clean vehicle tax credits, which are really, I think, aimed at consumers. You have used clean vehicle credits, which is a new one. And then alternatively, at the end of the day for all of this, because it's going to be charged by an exterior method for a battery, there's the question of infrastructure and what it's going to cost to put the infrastructure in. So who's interested in the alternative fuel aspects of this and how the IRA can help them offset some of those costs? So we'll just give a minute on that. All right, so this, I think, aligns somewhat with what Gabe and I had been talking about when we were putting this presentation together, which is we think there's a tremendous interest in commercial clean vehicles. Likewise, there's a real interest because regardless which of these you may want to pick, ultimately having the ability to refuel the vehicle is a significant cost, and anything that can be done to defray it likewise is important. And then lastly, I would say the new clean vehicle tax credit is also really interesting given how it's replacing the previous credit that we've seen. So with that, let's just give a quick little background about where we are, and then we'll hop into these four programs. So the Inflation Reduction Act was passed in August of 22. The real important piece, really there's two aspects of this. One, it was $370 billion in commitments to green investments by the federal government. And then the second one, which I'll just jump down to, is the length of time that this is going to be done over. So it's for qualified property placed in service after December 31st of 22 but before January 1 of 2033. And what that means from our perspectives, from a tax incentives perspective, is this is a program which is going to have significant longevity. One of the questions we frequently get is, well, what happens if there was a change in Congress or a change in the White House? I think our view is that, generally speaking, once incentives of this magnitude are put into the tax code, they are very difficult to remove. If anything, it's likely that as we get to the back end of this decade of incentives, that they will likely continue to be extended. So we do not necessarily see a change in Congress or the White House resulting in any of these incentives, being taken out of the law. So there are 4 programs we want to talk today about because of the interrelated nature of them. The first one, and this is a program that's been around for a while, Section 30C for clean refueling property, but it's enhanced, makes it far more lucrative to people that are looking to place this type of property in service today. The other thing is the legislation broadens Section 30 from a plug-in electric vehicle to what is now considered a clean vehicle. So they've really enhanced that. And then the other 2 credits, which are brand new, they enacted a Section 25E credit, which is to provide a tax credit for previously owned vehicles. And then the other one that, say best for last, I guess, for purposes of our audience, Section 45W, which is a tax credit for clean commercial vehicles. And so we're going to be spending some time on that. I would say, just from a threshold perspective, we're going to start with Section 30D, because that sort of then forms the basis for how we talk about the other programs, 25E and 45W. The other thing I would say, just from a 50,000 feet level, is this. There are a lot of programs that are in the Inflation Reduction Act. We're going to talk about 4 of them. While we have received some initial guidance from Treasury, we are expecting a lot more. A lot of the mechanics of, just like logistically, how is this all going to work? We're waiting for additional guidance on. So where we are today is going to be very different than where we are, say, in 6 months or a year from now in terms of the implementation of these programs. All right, so let's kick it off with what really is the underlying framework for everything, the Section 30D Clean Vehicle Tax Credit. And again, this is a credit that you or I or Gabe would be purchasing as individual consumers in most instances. And I just want to put that out there as distinct from the Section 45 Clean Commercial Vehicle Credit. So, the first question we get asked is, well, what is this worth if we were to, get involved in this program? So the maximum credit per vehicle is $7,500, but there's 2 components to that. Half of it is if the vehicle meets critical material requirements, and the other half is if it meets specific battery component requirements. Initially, Treasury was supposed to provide guidance, I think it was back in January or February of this year. They came out and they indicated that they were not going to be able to meet that deadline. They said that they would provide it in March of 2023. So where we currently sit now is the IRS has been collecting information from qualified manufacturers, which we'll talk about what that means in a little bit. And based off of their representations, those manufacturers have been identifying certain vehicles that they believe will hit these criteria to allow for consumers to receive this $7,500 benefit per vehicle. So sorry about that. So when we look at the limits that are applied to this particular credit, there's really 2 things you want to consider when it comes to eligibility. First is the value of the vehicle depending upon its classification, and the second is the income of the purchaser/taxpayer depending upon their filing status. And as you see from the slide, so vans, SUVs, pickup trucks, larger vehicles, MSRP can't exceed $80,000. For other vehicles such as sedans, MSRP can't exceed $55,000. I believe it was at the end of last year, there was one prominent manufacturer that reduced their MSRP prices for a variety of vehicles, I think it's fairly reasonable that you can draw a dotted line between that action in price reduction to wanting to qualify for these incentives for their consumers. The other side of the house for this is, so you have a customer come in, they want to purchase a vehicle, you know the size, you know the critical materials and the battery components, and you're good on that. But then the question becomes, does that individual's adjusted gross income meet or exceed the limitations for receiving the credit? And as you can see from the slide, single filers, you can't exceed $150,000. Heads of household, it can't exceed $225,000, and then for joint filers, their income can't exceed $300,000. How will a dealership verify income to ensure these qualifications are, you're not on the other side of that? It's an open question that we're waiting to see. But again, we expect that these are things that with additional guidance from the IRS, we're going to have a better, deeper perspective on how that will work. So then the question becomes, well, what is a new clean vehicle? So the IRS already has a website where they have begun listing certain models for certain manufacturers. But in essence, if you were to break this down, it's that the original use of the vehicle commenced with the buyer, and the vehicle has to be acquired for use or by lease, which is an important thing that we'll talk about, by the buyer and not for purposes of resale. The vehicle has to be made by a qualified manufacturer. And there are implications for that, by the way, for manufacturers of mobile machinery that we want to take into consideration. The vehicle has to weigh less than 14,000 pounds. It's treated as a motor vehicle for purposes of the Clean Air Act. The battery has to have a capacity of at least 7 kilowatt hours. It has to be rechargeable by an external source using electricity. Final assembly has to occur in North America. There was initially some discussion about just the United States, but ultimately they decided on that. And that ultimately, and this is going to be a key component that we're going to get into on the next page, the seller has to furnish a report both to the buyer and to IRS containing certain items. And the good news, at least, is the report is the same for each. So let's take a look at that, the mechanics of that. So if you're selling a vehicle that would qualify under Section 30D for a credit, you'd have to have the name and the taxpayer ID of the taxpayer, the VIN of the vehicle, unless there isn't a VIN which had been assigned, the battery capacity of the vehicle, verification that it's a new vehicle and that the use begins with the taxpayer. Then the maximum credit under Section 30D allowable to the buyer. And again, remember, with different components and half being critical minerals and half being battery, it is possible that the credit might be something less than $7,500. And then lastly, and this is going to be a key component of what we're going to talk about a little later in the presentation. So you have a buyer that comes in and they basically say, like, look, I don't actually want $7,500. I want a reduction in price. So you have a buyer that makes an election to transfer the credit to an eligible entity, which may be a dealership. The dealership then has to furnish to the buyer the full amount of the tax credit in the form of a rebate or other retail price reduction. So those are just some initial considerations about the type of report that the seller would need to put together. So this gets us into, you're at a dealership or you are a dealership and you have consumers coming in, they want to purchase a vehicle, but again, they don't want to wait to claim the credit. They want to have a reduction in price on the vehicle to reduce their overall payments. So let's just run through the example that we have here. Dealership D may sell a vehicle that's eligible for $7,500 credit to buyer B. But instead of taking that credit, B may elect to transfer the credit back to D in exchange for equal value. So they were going to buy a $50,000 car. They're going to reduce it by $7,500. So now their purchase price is $42,500. So again, in order to accept the credit for exchange for a lower price, the dealership is going to have done a couple things. They have to register with the Secretary of IRS for purposes of being an eligible entity. So they have to do that up front. They have to disclose to the buyer before the election the vehicle's MSRP, the value of the credit, plus any other incentives that may be available for the purchase of the vehicle, the amount of the credit being provided by the dealer to the buyer, essentially a reduction in price equal to the value of the credit. At the time of the sale, the buyer receives the benefit, and ultimately other incentives that are offered with the vehicle can't be limited to the buyer's ability to make the election, and the buyer's election does not limit the value or use of the $7,500 credit. So that's a long way of basically saying that this $7,500 credit can't be used to limit other opportunities that the buyer may have to reduce the price of the vehicle. But there are a couple steps that dealerships need to consider in advance of accepting these credit transfers from buyers. So it's just a question of making sure you get all that taken care of beforehand, before you start engaging in these credits. So here's just sort of a visual representation of what would happen. The buyer comes in, they are eligible for a $7,500 credit. The $7,500 credit flows up to the dealership. It's transferred to them by the buyer. And then in exchange for that, the dealership grants an equal reduction in price of the vehicle. So just to give you a visual for how that might look. All right, so that said, there is an aspect of what we are aware of what's coming that's kind of hard to comment on right now, which is advance payments. Because say you're a dealership and say you accumulate 100 of these $7,500 credits. So you have all of these credits that are sitting there. When do you claim them? And that's one of the unanswered questions that we're currently working through. The Secretary of the Treasury has been tasked to create what is called an advanced payment program. And the idea of this is that at certain points in time, dealerships will be able to cash in those $7,500 credits essentially in cash, rather than having to wait for an entire calendar or tax year in order to claim those on a return. We have not seen that yet. We are awaiting that guidance. That will be critically important to allow for dealerships to monetize these as quickly as possible. And with that, I'm going to turn it over to Gabe for him to speak on Section 30D, critical minerals and battery components.
Thanks, Craig. This section, we're going to take a look at the critical minerals and components that make up the batteries of the EVs. And, I think as we put this together, we realize that from maybe a dealership standpoint, this is something that you're going to expect the manufacturers to kind of take care of and understand. And Craig mentioned a list that the Treasury is going to have that's going to list the approved manufacturers based on these critical minerals and battery component requirements. However, for those in the audience that might be smaller manufacturers or, creating mobile machinery, this will probably be important as the IRS is going to roll out guidance as to the requirements of what's going to be necessary to qualify under critical mineral and battery requirements. So far, as Craig mentioned, we have not seen guidance yet. We expect it to come at the end of in March, but we do have some idea of what the IRS is going to do. They did release a white paper that gave us, some insight in the direction that they're looking to go with respect to the amount of critical minerals and battery components, and that's going to come down to requiring a certain percentage. They call it the applicable percentage. That guidance is going to outline how much of the battery needs to be made up of critical minerals that will be sourced out of North America. Same thing with the battery components. The certain percentage of the battery's value is going to have to come from manufacturing plants or assembly plants in North America. So we'll get into the details in the next slide, but it's looking like it's going to ramp up over time once the guidance is issued. And we expect again in March that you're going to need to have a certain percentage of your critical minerals and a certain percentage of the battery components be sourced or manufactured in North America. And it starts off at a significant rate. It's going to be at least 40% for the critical minerals, 50% of the components of the battery will need to, meet these requirements. And then they're going to get stepped up over the next, 4 to 5 years. If the guidance stays true to the white paper and what we expect, then you're looking at 80% of the critical minerals will need to come from, will need to be sourced from North America, and 100% of the battery components need to be either manufactured or assembled in North America. So really pushing the ability for North American manufacturers and suppliers to be a big part of this credit. So real quick, what are the critical minerals and what are the battery components? I think we all associate lithium as a critical mineral when it comes to EV batteries, but there's also manganese, cobalt, and graphite. Those are listed by the IRS as critical minerals that will need to be sourced from North America. Some examples of the battery pack components that will need to meet the requirements. It's the battery pack, the relays, the sensors that gauge the temperature, voltage, and current, and then the connectors and the charging socket. So it really is kind of, when you think of a battery, the complete system that for the EV that's going to get it to get the vehicle to operate. Again, this is what the white paper has alluded to, and so we're hoping to get that guidance in March, and looking forward to getting that out to people once we have that time to digest it. Again, so moving on to another credit that the IRA created, expanded and extended, is the alternative fuel vehicle refueling property tax credit. I like the shorthand of Section 30C. I also like an even shorter shorthand is just, the EV charger. But it's open to more than just EV charging equipment. So what is the credit amount? Like a lot of the credits laid out by the IRA, it's a 6% credit on the cost of any alternative fuel vehicle refueling property. It's capped at $100K per item of qualified property, and the credit is 6% of that qualified property. For all the other non-depreciable property, the credit is 30% of the cost, capped at $1,000 per item. As is the case with a lot of the credits in the IRA, that 6% credit is open to a 5-time multiplier, a 5-time bonus, if the project, the alternative fuel project or the EV charging station construction project, meets both the prevailing wage requirement and an apprenticeship requirement. And we'll get into that, explain that in the next slide. So alternative fuel vehicle charging station or equipment is constructed, the laborers and the mechanics that perform that work will need to meet a prevailing wage that is outlined by the Department of Labor. This requirement will need to occur during the entire construction of the property installment. Apprenticeship requirement, there's a minimum percentage of the total hours that a construction will have to meet the qualified apprentices who participate. They will need to be in a registered apprenticeship program that complies with certain federal requirements. This requirement also applies during the entire construction period. And we laid out the percentages, 10% in 22, it ramps up to a maximum of 15% in 2023. So that's the credit. It's 6% unless you meet the prevailing wage and the apprenticeship requirements. But what is qualified alternative fuel vehicle refueling property? Well, I like to narrow down. I like to look at EV charging equipment, but it's open to more than that. But the property needs to be depreciable. It needs to be placed in service by the taxpayer. So it needs to originate with the taxpayer. And it needs to be for either storing or dispensing clean burning fuel or recharging motor vehicles that are propelled by electricity. So again, a lot of the focus has been on EV chargers and EV charging stations, but it's open to other clean burning fuel storage or dispensing of that type of fuel. A big part of this eligibility for whether or not you'll be able to take this credit is where the charging stations or refueling property will be placed in service. And so there's a census tract requirement. An eligible census tract needs to be located in either a low-income community or located outside an urban area. And those definitions are listed by Commerce, and we outline them here. But the main consideration is if you're going to be investing in charging stations or other alternative fuel property installations, you're going to want to make sure that you are in an eligible census tract. Otherwise, you will not be eligible for the credit. So that's important. Another thing to consider is that there are related state programs that you can kind of lay on to along with the federal program for charging stations. We're not going to get into all of them, but with respect to EVs, there are a couple states in the West that offer programs. They're typically discretionary. You need to apply for them ahead of time. They have different priorities, but Colorado and California are two examples of states that offer rebates for EV charger installations. And one thing we do want to talk about with respect to these credits, and then a lot of the credits that are included in the IRA, are direct pay and transferability. And so this is something new for a lot of these credits. The hope is to ensure that more types of entities, more businesses are able to take advantage of these credits, whether or not they're taxable or not. And so you see that the alternative fuel vehicle refueling properties at 30C is eligible to be transferred. That is something where if you are a taxpayer that doesn't have federal tax liability, you can actually sell this credit on the market and be able to monetize the credit for use. The direct pay is another interesting aspect from the IRA that is open to 30C and 45W that Craig's going to get into in just a bit. But the direct pay, that's important because what it amounts to is a refund. It makes the credit refundable to taxpayers that are not paying federal tax. And so you say there, applicable entities is what the IRS is calling them. Those applicable entities are tax-exempt entities, state or local governments, the Tennessee Valley Authority, tribal authorities, and Alaska Native corporations. And so that broadens the appeal to these credits to a broader audience and allows them to be monetized on several different levels. And with that, I'm going to turn back over to Craig to talk about the commercial clean vehicles tax credit.
Thanks, Gabe. And the only thing I would piggyback on your comments, I thought it was really interesting about, so you have these federal incentives, but there are certain state programs that require applications. Gabe and I do a decent amount of site selection work for clients. And one thing I would just note is for the stakeholders we have on the call, when you're going back to your organizations and talking about what their plans may be for expansion or putting 30C property into service, we can't have that conversation soon enough. It's very challenging when companies are either signing leases or they're breaking ground 2 weeks and the question comes back, well, what can we receive from a tax benefit perspective? We deal with state agencies. Maybe Gabe and Craig can stay up all night and work as hard as we possibly can. But a lot of these agencies have timelines for approval for these programs. And so it's really important that we have enough time to work through the application with you, submit it, and give the agencies enough time. Texas can take weeks or months on particular items, and we can't make that work any faster. So we just say, to the degree you're contemplating any of these things, the sooner a conversation can be had, the better off everyone is for trying to obtain those benefits. But that said, let's talk about 45W qualified commercial clean vehicles. And we have a polling question, which is, are you actively considering replacing a significant portion of your fleet with clean vehicles? Yes, it's a priority for us. Yes, but we'll focus on a small percentage of our fleet at first. C, depends on what we learn about this credit. Or no, the current vehicles in our fleet are working just fine for us. And considering the fact that there's a 10-year window for these opportunities, it could be very reasonable to say we're not in the market just yet, but in 4, 5, 3, whatever that number of years would be, after the dust is settled on these programs, it would be something that we contemplate pursuing. So we'll give everybody just a minute or two to address these questions. All right, so it looks like it depends, which is always a good answer. Accounting firms love that, as do fellow attorneys. And alternatively, it depends, we'll focus on a small percentage of our fleet, which I understand. You want to pilot this, make sure it works for your organization first. So let's get into it. All right, so again, this program is a little different than what we've seen in the past with 30D, but 30D really does form the basis of this. So a qualified clean commercial vehicle tax credit is equal to, and it's the lesser of one or the other. So it's either 15% of the taxpayer's tax basis in the vehicle, and then they get into a 30% in the case of the vehicle not powered by gasoline or diesel internal combustion engine, or the incremental excess, meaning excess cost of the vehicle relative to a comparable vehicle. But there are some caps around this. So the credit is capped at $7,500. So we go back to that for vehicles that weigh less than 14,000 pounds. Vehicles above that weight threshold may be eligible up to a maximum of a $40,000 credit. So the limitation for this is the credit won't be allowed with respect to any vehicle for which you receive the 30D credit for. So again, when we started this, it was consumer vehicles, Gabe, you, and myself going to buy a vehicle at a dealership. Now we're talking about, we have a commercial need and we're going to buy a commercial vehicle. So we can't double dip on these two benefits. All right, so how do you define what a clean or qualified commercial clean vehicle is? So again, it goes back to the vehicle has to be made by a qualified manufacturer. And again, that gets back to registering with Treasury. And that's a process to go through. And we have seen certain large manufacturers already begin to do that. The vehicle must be acquired for use or lease by the buyer and not for resale. The vehicle must either be a new clean vehicle, under the meaning of 30D, meaning it hits those requirements, or considered mobile machinery. And I know for a number of the people on this call, that's going to be what your interest in this particular program may be. There's no reason you couldn't be a qualified manufacturer, but it will require going through the steps to register with the IRS in order to do that. The vehicle must either be a new qualified fuel cell motor vehicle or have a battery capacity that's commensurate with the vehicle weight. And so what we're seeing is vehicles that have less than 14,000 pounds have to have a battery capacity of 7 kilowatt hours. If you're over 14,000 pounds, you have to have a 15 kilowatt battery capacity. And then, of course, the vehicle does have to be depreciable property. So there are a couple different state and local programs that if you're doing this for federal purposes and you happen to be in the right place in a given state, and again, to Gabe's point, we can't possibly list all the various state programs that are out there, but there are some states, probably, California comes as no surprise. They have the Carl Moyer program, which is a voucher incentive program to replace older gas-powered vehicles with new or used zero-emission vehicles. And then again, that program received an update in 22 for on-road heavy-duty vehicles. So these are some things that you may want to consider. For people that have been in this industry for a while, you're probably familiar with the Volkswagen Mitigation Trust Fund that was put together. There's, like a lot of these trust funds, it's several $1 billion. The states receive the funds. In turn, they direct those monies to various different programs. So it's going to depend on where you are and what the focus of that state may be. But again, if you're in the process of doing this, while there may be issues with double dipping between 30D and 45W, we have not encountered a situation where receipt of a state program somehow impacts a federal program. So something to consider. All right, so let's talk about leasing clean vehicles, because this is something that we've had conversations with clients they're pretty curious about. And if you have a vehicle that qualifies for 30D or 45W credits, there are a couple things that we want to keep in mind. So in each instance, the person taking the credits must be the original user, meaning the vehicle can't have been used by another taxpayer previously. So the IRS states specifically in its FAQs, and we've discussed this with a number of different groups, that the vehicle is acquired for lease to another person. The lessor is the original user, which is good news, likely from your institutional perspectives. So here's sort of a model of what we're seeing. So you have a dealership on top, you've got a customer, and you have lease co, and this sort of demonstrates the leasing relationship. So just to walk you through what the bullets are on the side, the dealer brokers the deal with the customer. The customer selects the vehicle from the dealer, and the dealer ultimately delivers that vehicle to the customer. Now, we're presupposing, of course, that vehicle is one of the qualified vehicles made by a qualified manufacturer, but assume for argument's sake that that's the case. The dealership sells the vehicle to lease co. Lease co earns the credit. The credit is a 45W credit in the hands of the leasing company. The lease contract exists between the customer and lease co, presumably reflecting a lower lease payment due to the credit reducing the overall price of the vehicle. And again, we feel comfortable that this type of structure would work. It's been a question we've received very frequently because of the lease co, basically coming into the transaction. Would there be a problem with transferring the credit? And we believe the answer to that is no. With that, I'm going to turn it back over to Gabe for Section 25E.
Thanks again, Craig. So Section 25E, it's, previously owned or used clean vehicle tax credit. This is another new credit created by the IRA and primarily aimed at consumers, at the individual. So the amount of credit is, to qualify, the used vehicle must have a sales price below $25,000. We've seen that kind of reflected in Section 30D, where there's limits to the amount of the price of the vehicle. So similar here, it's 25 must have a sales price below 25,000 to be eligible for the credit. And so the credit is going to be the lesser of $4,000 or 30% of the sales price of the vehicle. Like we saw with 30D, there are income limits, AGI limits. We list them here for single filers that AGI cannot exceed 75,000. For heads of household, AGI cannot exceed 112,500. And for joint filers, the modified AGI cannot exceed 150K. So what is a used clean vehicle or a previously owned clean vehicle? To be considered a previously owned clean vehicle, the model year of the vehicle is at least 2 years earlier than the calendar year in which the buyer acquires the vehicle. The original use of the vehicle must commence with the person other than the buyer, though not the original owner. The vehicle must be acquired by the buyer in a qualified sale, and the vehicle meets the same requirements under 30D, and has a gross weight of less than 14,000 pounds. And I think for those that are familiar with the 14,000 pound kind of benchmark, that's typically light duty vehicles, and I think one class of medium duty vehicles. So we're not looking at large, heavy use vehicles for any of these, for most of these credits. Qualified sales by a qualified dealer. Again, the price of the car has to be $25,000 or less. The qualified sale means that it's the first transfer of the vehicle since August 16th, 2022 to a qualified buyer other than the original buyer. A qualified buyer is an individual who purchases it for their own use and who cannot be claimed as a dependent on another person's tax return. The final piece of a qualified buyer is they have not taken a 25E credit for any other vehicle during the 3-year period ending on the date of the sale of the vehicle for which they're taking the credit. So a few items to be aware of when trying to take or looking to purchase a previously used clean vehicle. That price point is $25,000 or less. So that's a good place to start. That might limit the amount of vehicles that you're looking at. So in kind of wrapping this up, we're looking at guidance to come in March and in other areas of the IRA later on in the year. That's really going to help us understand these credits going forward for, as Craig mentioned, the next 10 years. The lifetime of these credits is on the statute is 10 years. And as Craig mentioned, it's very difficult to remove a law once it's been enacted. So we would expect that these credits would be at least through 2033 or the end of 2032. The IRA launched a lot of programs. There's a lot of guidance that the IRS has to get to. We're excited that the clean vehicle related guidance is coming in March and that other guidance will come throughout the year, but it's something to keep a lookout. We'll obviously be keeping folks posted with guidance as it is released. And I think with that, we have our final polling question. Now that you learned about these credits, which incentive will you likely pursue? And I think at least on my screen, the bullets are a little off, but are you looking to pursue the new clean vehicle credit, the commercial clean vehicle credit, the alternative fuel vehicle credit, or the used clean vehicle credit? We'll do that in that order. Just to try to get a sense if there's anything that we said today that may have piqued your interest to pursue. It looks like folks are interested in the used. That was the last one. I think B, I said, was commercial clean vehicles. I don't think I'm too surprised that would be a big item of interest for folks. But a good mix. And I think with that,
Gabe, there were a couple questions which I can take a stab at. One of which was, and I think it's a fair question, is why would a dealer reduce the price by the amount of the credit? Let's say it's $7,500 for a customer. A dealer would lose money on each vehicle and then have to wait for the credit from the government. And I think that's, I think for the person asking that question, it's an extraordinarily fair question. And it is a choice. Our thought would be the consumer may be incentivized to pick one dealership that does offer that incentive compared to another dealership that does not. Now, the market will bear that out. Now, your question on timing around when would that dealership actually see the $7,500 is a fantastic question, which actually bleeds into another question around, can Moss Adams help with the monetization of these credits? As a firm, Moss Adams has been involved in the transfer of credits both on the federal and the state level for well over a decade. And we do that to answer the question directly. But to the question about why wait that length of time, it's a question that we have 2 calls a week on this particular subject. And the question that hangs over everybody's head is, what is the frequency with which the IRS will allow you to monetize this? And it's a real concern that you could start accumulating these credits at the beginning of 23. Maybe the process isn't in place to claim these credits until sometime in 24. And you as a dealership are holding on to this for that length of time. I can't tell you that necessarily makes sense for you to do or not to do. But that's a question that when we have guidance, and I'll speak to that in just a second, around the transferability of this, we hope to be able to address in further detail. When you look at the programs in the IRA that the IRS has to address, there's probably 15 major credit programs. And we're just talking about those. We're not talking about all the other stuff that's going on in the world that the IRS is trying to address. When you think about transferability and monetization for these programs, that is the final step. Manchin was talking about the fact he wanted to pause the Section 30D credit until the IRS came out with guidance around minerals and batteries. So, but when you think about it, it stands for the proposition they have to get through all of the other mechanics to make this work before they get to how does a taxpayer actually receive any funding for this. And I don't know the answer to that. We hope it's frequent, but it may not be. It depends. I don't know if you had anything you wanted to add up to that, Gabe.
No, I think it's a good outline. I mean, we're always hopeful that the guidance is going to come sooner than later, but considering the amount of guidance that is outstanding, I think it makes sense that we're going to be waiting for a while for certain pieces, and to that end, transferability and that monetization aspect might be one of the final pieces of guidance that are released.
Yes. And then there's a question related to the requirements of mobile machinery. Can we talk about that in a bit more detail, and helpful to understand if the manufacturing of the machinery is also can be the dealer, and does that impact the ability to claim the credit? So if we were to go to, and bear with me for just a second while I look on my other screen, but when our annex that you'll receive with the presentation actually contains a huge amount of information in it. And let's see if we can just get there real quickly to put that up on the screen. So mobile machinery. So this is sort of the outline for it. So it's technical. It's mobile machinery is defined in the IRC, and it consists of a chassis that has items that have been permanently mounted, machinery or equipment to perform construction, manufacturing, processing, farming, mining, drilling, timbering, or similar operations if the operations of the machinery is unrelated to transportation on or off the public highways. So there's a couple aspects to that, including not being on the highway, and also fitting in a number of categories, which has been specifically designed to serve only as a mobile carriage and mount for the particular machinery and equipment involved. So you're not going to be using this for everything, whether or not such machinery or equipment is in operation. And you have, which by reason of special design could not, without substantial structural modification, be used as a component of a vehicle designed to perform a function of transportation, any load other than the particular machinery, equipment, or similar machinery or equipment requiring such specially designed chassis. So you're really talking about something that's very specific, designed for a specific purpose, that's off-road. And so to that end, we have to work through those specific definitions to make sure that the property actually qualified, but it's very viable. I think the question, though, further gets to the manufacturer / dealer could be one and the same, but they probably have to register as separate entities, one as a manufacturer, one as a dealer, for purposes of claiming this. It is possible that the IRS guidance down the road may say one is sufficient and you don't have to do both. But I know that within our appendix, we also have sort of pro forma, this is what the IRS has said that they would want to see from a documentation standpoint, that this is what you would fill out and provide to them. Obviously, there would be additional documentation that you're going to have to validate for the IRS, meaning that you meet the requirements, but the form of what you would have to provide, we included in the appendix for everyone on the call to take a look at and work through. And yes, we do anticipate mineral and battery requirements applying to 45W as well. But again, we think that in those particular cases, it's going to really rely on the manufacturer to certify that. And that may require, if you're a large, you could name them off the top of your head, type vehicle manufacturer, we assume that they will be providing that to the IRS. For other manufacturers, say for mobile machinery, that's going to be a process that they're going to have to go through that may be, a little more challenging because of the scale of their operation. I don't know if there were any other questions. I think that was the majority of the questions that I can see.
I thought I saw a question about income limits for the used vehicle versus the new. Is the income limits for the used vehicles the same as the new? No, the AGI limits for the new clean vehicles are twice that of the used vehicle. So I think for joint filers, it was $300K for a new vehicle. It's only $150 for the used vehicle.
So I think based on that, while we are a minute or two early, we have addressed the questions that were in the chat. And I'm going to turn it back over to Amy. And we appreciate everybody taking their time today to come and listen to this. If you have any questions, please reach out to Gabe or to myself. This is really the beginning. And I think some of the questions really hinted at unanswered questions that we all have around how these programs are going to operate. So thank you very much for the input.
All right. Thank you, Craig and Gabe, for an informative presentation today. And as Craig mentioned, feel free to reach out to our presenters if you have additional questions. Their contact information is located in the slides as well as in your console. And if you'd prefer we reach out to you, please drop a comment in the Q&A window letting us know that. And for those of you that would like a copy of the slides, you can download them from the folder that says slide deck and handouts. We'll also be sending them via email tomorrow, along with a recording of this webcast. And finally, here's a link to an online survey for today's presentation. And thank you for joining our webcast. Take care, everyone.